Now speaking, Todd Ernst, Vice President, Investor Relations. Good morning and welcome to Northrop Grumman's second quarter 2023 conference call. We have posted a PowerPoint presentation on our IR website for your reference. Today, we will discuss our guidance and outlooks for 2023 and beyond, keeping in mind that these are forward-looking statements subject to risks and uncertainties. Our SEC filings and press release provide more details on these risks. During this call, we will also be using non-GAAP financial measures, which are reconciled to our GAAP results in our earnings release. Joining us today are Kathy Warden, our Chair, CEO, and President, and Dave Keffer, our CFO. I will now hand over the call to Kathy. Now speaking, Kathy Warden, Chairman, President, and Chief Executive Officer. Good morning, everyone. Our second quarter sales were up 9% with solid contributions from each of our four business segments. We are increasing our full-year sales guidance range by $400 million due to our strong year-to-date sales increase of 7% and an improved outlook. Our book-to-bill ratio in the quarter was 1.14, and we are increasing our full-year book-to-bill projection to approximately 1.0. Our backlog of $79 billion supports our long-term growth outlook. We delivered solid second quarter earnings per share of $5.34 and are increasing the lower end of our full-year guidance range by 20 cents. Our free cash flow was healthy in the quarter, positioning us well for our full-year target. We are encouraged by the continued bipartisan support for national security funding in the U.S. and anticipate increased demand for our products as our allies increase defense spending. We are well positioned to meet this demand with programs such as IBCS, and E-2D, as well as munitions. We have a path to margin expansion, with a target of 12% in the longer term. This is built on three key drivers: stabilization of macroeconomic factors, cost management programs, and a shift in our business mix to more international and production contracts. We are making progress in reducing supply chain disruptions and improving labor efficiency. We are also implementing digital solutions across our business to drive performance and productivity. Our business mix is shifting towards more fixed-price revenue, which will contribute to higher margins. We expect our international business to grow at a double-digit rate over the next few years. We are executing a capital deployment strategy that prioritizes investments and returning cash to shareholders. Overall, we are confident in our growth trajectory and focused on margin expansion and free cash flow growth to deliver value to our customers and shareholders. Now speaking, Dave Keffer, Chief Financial Officer. Good morning, everyone. We had a solid quarter and are well positioned for future growth. We generated $10.9 billion in new awards, exceeding expectations. Our book-to-bill ratio was 1.14, driven by $5.4 billion in restricted bookings. We expect production awards in the second half, including the first lot of B-21 RIP. Sales grew by 9% in Q2, with all four business segments showing growth. Space led with 17% sales growth, while Defense Systems grew by 10%. Segment margins were 11%, with program performance remaining strong. Diluted EPS was $5.34, impacted by lower net pension income. We generated strong free cash flow of over $600 million, a significant increase from last year. We are increasing sales guidance for space to the high $13 billion range, reflecting a four-year CAGR of 17%. Defense Systems full-year expectations are in the mid to high $5 billion range. No changes to revenue expectations at AS/MIS. We expect a growth rate between 5% and 6% for the full year. Our EPS outlook assumes the Q3 closure of a minority investment sale. We are on track to grow free cash flow to about $3 billion by 2025, with an opportunity to double our current level over the next 5 years. We continue to execute our balanced capital deployment plan, including investments in R&D and CapEx, returning excess capital to shareholders, and retiring $1 billion of notes. Overall, we delivered a strong first half and are driving growth in sales, earnings, and cash. Vertical Research Partners analyst Robert Stallard inquired, Kathy, could you please provide an update on the margin expectations for the B-21 RIP? Is it still projected to have a break-even margin? Additionally, does the end of the F-18 have any impact on this? Kathy Warden replied, our margin projections for B-21 do not include margin from RIP contracts. We have accounted for the risk factor associated with B-21 and inflationary impacts. The DoD has allocated $60 million for B-21 RIP procurement due to inflationary impacts, which we expect to be awarded later this year. However, this only applies to FY23. We are working closely with the government to address the impacts of macroeconomic disruption. Our projections also incorporate the line down of the F-18 production line, as we have been anticipating it. The production profile is driven by aerospace programs like B-21 transitioning into production and F-35 continuing to grow, as well as programs shifting from development to production in all four of our segments. Vertical Research Partners analyst Robert Stallard inquired, could you clarify the contractual structure of the HALO program? Kathy Warden replied, the HALO program is a fixed-price contract. We had a more mature design after the preliminary design review, which was conducted under a cost-plus structure. We are now being more disciplined in our use of fixed-price contracts, which are best suited for commercial items or production programs with stable requirements and mature designs. Unfortunately, the requirements for the HALO program have not been as stable as expected, so we are working with the government to address the changes. Seaport Global Securities analyst Richard Safran inquired, could you provide any insight into your plans to bid as a prime on the God 6th generation fighter program and how it fits into your growth strategy? Kathy Warden replied, thanks, Rich. We have notified the U.S. Air Force that we are not responding to the God RFP as a prime, but we are responding to other bidders' requests for proposal as a supplier, particularly in our mission systems portfolio. We are remaining disciplined in assessing the right programs to pursue, and this one did not meet our criteria for an appropriate balance of risk and reward for both the customer and the industrial base. Our decision does not impact our path to sales and earnings growth at NGES, as we have a strong backlog in that sector and other opportunities in military aircraft that we are pursuing. Bank of America Merrill Lynch analyst Ron Epstein inquired, could you please explain the implications of the no bid on FA-20 and the related programs? Kathy Warden replied, I can confirm that we are pursuing other opportunities. We are confident that the government is balancing risk and reward appropriately, and if that is the case, we will pursue those opportunities. Morgan Stanley analyst Christine Lee Wog inquired, can you explain the strategy behind not bidding as a prime for God and how it will affect margin growth in the coming years? Kathy Warden replied, Christine, we believe that disciplined bidding is essential to our success. We have learned from our past experiences and are applying those lessons to our bidding process. This will help us to expand our margins and meet our commitments to investors. We also believe that this discipline is important for the entire industrial base to remain healthy and attractive to investors. AllianceBernstein analyst Doug Harnd inquired, given the recent inflationary environment, do you expect to be able to price new contracts at a level that will allow you to maintain the same performance as before the pandemic? Kathy Warden replied, yes, Doug. We expect inflationary pressures to be reflected in our actuals. This will provide us with the basis to negotiate higher costs in future contracts with the government. AllianceBernstein analyst Doug Harnd inquired, can you explain how the budget will cover the increased costs over the next 12 months? Kathy Warden replied, I anticipate that the budget will need to account for increased costs. Inflation could cause the government to require supplementals or prioritize what they purchase. We're already seeing this, with the government reducing quantities on programs to address higher costs. This is likely to continue as contracts come up for renewal. Jefferies analyst Sheila Kahyaoglu inquired, can you provide more detail on the $1.6 billion of sales growth you anticipate in 2023? How much of it is GBSD and what are the margin implications? Kathy Warden replied, our growth this year has been driven by two programs, GBSD and NGI, which account for approximately half of the growth. The other half is coming from a broad set of programs, most notably our national security portfolio, which is 80% of our overall revenue in the space business. Our margins are similar across these businesses, with early phase development being lower margin. As we shift into production, we expect our space margins to continue to expand, and we're pleased with the 9% we're seeing. We're working to get that closer to 10%, and with the right mix, we have the potential to go even higher. Despite the disruption of the macroeconomic environment, we feel like we're in a good place. Wells Fargo Securities analyst Matt Akers inquired, what are your thoughts on Sentinel's performance and any potential risks associated with the Cost Plus program? Kathy Warden replied, yes, thank you for the question. Regarding Sentinel or GBSD, there has been a GAO report that highlighted schedule pressure due to supply chain disruption. We are working with the U.S. Air Force to optimize the schedule and maintain the initial operating capability, which is the primary focus of the government. This will ensure the replacement of missiles in the silos as planned later in the decade. Wells Fargo Securities analyst Matt Akers inquired, could you comment on your expectations for working capital in the second half of the year? Dave Keffer replied, sure, Matt. Our working capital status is strong and efficient compared to the industry. We saw a $1 billion improvement in free cash flow year over year due to our invoicing and collection efforts. We anticipate a typical seasonal pattern with the strongest free cash flow and working capital efficiency in the fourth quarter. Overall, I'm pleased with our working capital performance. Robert W. Baird & Company analyst Peter Arment inquired, Kathy, Dave, Todd, when do you anticipate the cost plus to fixed price mix to peak? What is the outlook for working capital over that same period? Will it be a headwind or an opportunity? Dave Keffer replied, so those are the primary drivers of the free cash flow opportunity over the next 5 years. Thank you, Peter. Our cost type work is at a high watermark this year, with a 55% cost plus mix in the first half of the year. We expect that to ease slightly in the second half, but over the next 4 to 5 years, we anticipate a shift back to a 60 to 40 fixed price mix. This will provide a meaningful opportunity for margin expansion. Working capital is expected to be neutral over the next 5 years. The primary drivers of free cash flow growth are sales volume, margin rate, capital intensity, cash funding, and cash taxes. Shapiro Research Analyst George Shapiro inquired, "What losses should we expect from the B-21 option and how will you handle it?" Dave Keffer replied, "George, the first flight test aircraft powered on in Q2 and we remain on track for first flight this year. Following first flight, we anticipate awarding the first LRIP contract. We'll evaluate the performance and outlook for B-21 RIP and EMD on a quarterly basis and provide updates as we have them. We'll take into account progress in driving efficiencies, the first LRIP contract lot, and other factors when updating our thinking." Shapiro Research Analyst George Shapiro inquired, "Can you explain the reasons for the slowing of revenue growth in the second half of the year compared to the first half?" Dave Keffer replied, "Sure, the growth rate for space has increased to the low double digits, and we're pleased with that. The first half of the year was closer to 17%, which is due to the year-over-year compares being lighter than Q4 in 2022. This is the case across the business. We anticipate a lighter year-over-year growth rate in the second half of the year, but we're still looking for sequential growth. Overall, 51% of our sales guidance is in the second half, and 49% in the first half, demonstrating continued sequential growth." J.P. Morgan Chase & Company analyst Seth Seifman inquired, "What is driving the margin pressure in the space sector and how do you assess the risk going forward? Are there any fixed-price development programs that could further impact margins?" Kathy Warden replied, "Overall, the space business is performing strongly. We are focused on improving our management of programs and customer relationships to ensure that risk is managed appropriately. Development programs tend to have lower margins, but as space transitions to later-stage development and production, performance is on par with the rest of the business and we anticipate that trend to continue." J.P. Morgan Chase & Company analyst Seth Seifman inquired, "Are you planning to pursue the collaborative combat aircraft portion of NOC?" Wolf Research analyst Miles Walton inquired, "Kathy, what is the expected margin expansion for 24? Dave, is the $100 million gain in the third quarter included in your guidance?" Kathy Warden replied, "I expect our margin profile to improve in the second half of this year, with macroeconomic disruption dissipating. We anticipate a gradual shift toward 60% fixed price by 2027, with steady progression of improvement through 2024. Dave Keffer replied, "The $100 million gain from the sale of an international minority investment is expected to close in Q3. We increased our guidance range by 40 cents last quarter to reflect this, and we anticipate the cash inflow from it to be beneficial to the company." Barclays analyst David Strauss inquired, "Kathy, with us returning to growth in 24 and space growth slowing, what is the expected top-line growth for the company?" Kathy Warden replied, "We're pleased with the progress we've seen this year, particularly in our sales guidance increase and our other two sectors. We've seen a strong backlog develop and competitive bids won, as well as supplier deliveries delayed last year coming in this year. We've also ramped up our headcount, which is contributing to our growth rate. We expect this growth to continue into next year and anticipate another year of healthy growth in 2024. Dave Keffer replied, "David, to your point, we expect the growth to be more balanced across our 4 sectors going forward. We've seen a recovery in our defense systems business over the last couple of quarters, and we anticipate continued opportunities for growth in each of the segments." Barclays analyst David Strauss inquired, "What is the size of the F-18 today, and when do you expect it to be fully phased out?" Dave Keffer replied, "Sure, production is expected to wind down over the next couple of years, representing 1% or less of sales. This is factored into our plans for growth in sales over the same period, along with other considerations discussed during the call." Citi analyst Jason Gursky inquired, "What is the size of the B-21 program in the remaining 30% of the backlog?" Kathy Warden replied, "The B-21 program's remaining backlog is relatively small because the EMD program is nearing completion. We anticipate receiving the first production contract later this year, which is priced and will be a contractual commitment. The largest program in backlog is Sentinel, which was awarded in 2020-2021 and will carry forward for several more years. It is a cost-plus program, and there are several other programs, but none that rise to that level." Dave Keffer replied, "The remaining 30% of our 2021 backlog will gradually transition into sales over the next few years. There are no major drivers of this remaining portion." Citi analyst Jason Gursky inquired, "Could you please provide some insight into the potential for margins to exceed 10% in your space programs, and what kind of work is driving that potential?" Kathy Warden replied, "Yes, the space market has shifted from large, expensive assets developed under cost-plus to production of higher quantity. This shift has impacted our portfolio, with programs like Sentinel transitioning into production and Kuiper being discussed. This mix shift will be a positive for our margins over time. Milius research analyst Rob Spingarn inquired, Kathy, given the shift from GEOs to MEUs and LEOs in satellite constellations and the importance of SDA in that market, would you consider becoming a supplier to take advantage of fixed-price contracts? Kathy Warden replied, we evaluate each opportunity carefully, taking into account the risk profile and the maturity of our designs and offerings. We have been successful in our work with the Space Development Agency and have chosen to prime or supply based on the right mix of risk/reward. Kathy Warden replied, thank you all for joining us today. I'm grateful for the Northrop Grumman team's hard work and dedication to global security. I hope you all have a great summer and I look forward to speaking with you again in October.